You're bleeding capital because you're trading chaos, not opportunities, not setups, chaos. The 5-minute chart displays every impulsive reaction, every algorithmic fluctuation, every meaningless price movement that has zero bearing on where the market is actually headed. It appears to be actionable data. It seems like you're observing more, comprehending more, capturing movements faster. But you're not. You're witnessing randomness masquerading as pattern. And randomness doesn't generate profit. I discovered this through painful experience. I dedicated 2 years to lower time frames, 5-minute, 15-minute, occasionally 1 minute when I was convinced I could nail the perfect entry. I examined every candle formation. I analyzed every shadow. I believed I was being meticulous. I thought more information equaled superior decisions. I was mistaken. Those 2 years drained more capital than I care to acknowledge. Not because I couldn't interpret charts, but because I was interpreting the wrong charts. The moment I transitioned to higher time frames, everything transformed. Not my approach, not my risk protocols, simply my perspective. And that shift in perspective moved me from break-even to consistent profitability in 3 months. I learned that becoming proficient on lower time frames without mastering higher time frames is worthless. And this understanding is something every trader must experience. Let's explore why higher time frames consistently prevail. And I mean consistently. This isn't about personal preference. This isn't about trading style. This is mathematical certainty. Lower time frames deceive. Higher time frames reveal truth. And if you want to generate income from this discipline, you must comprehend the distinction. Imagine standing beside a river. If you concentrate on one specific spot directly in front of you, you'll observe water swirling in various directions, small eddies flowing backward, currents moving sideways, splashes that appear random. If you only examined that single spot, you might conclude the river has no direction. You might believe it's pure chaos, but step back. Observe the entire river from elevation. Suddenly the direction becomes undeniable. The river flows one way. All those small swirls and eddies are merely surface disturbances. They don't alter the fact that the river itself moves in one clear direction. That's the distinction between lower and higher time frames. The higher time frame provides a clear understanding of which direction to trade. The lower time frame offers the opportunity to identify a superior entry for that trade. But if you only operate according to the lower time frame, you might be seeking positions against the higher time frame. And if you're doing that, regardless of how pristine the trade appears technically, you're extremely likely to get stopped out because you're attempting to swim against the current. That's precisely what's occurring. The 5-minute chart is you staring at that isolated spot. Every candle feels meaningful. Every reversal feels like a trend transformation. Every spike feels like an opportunity. But it's not. It's just surface noise within a larger framework. The daily chart is you stepping back and perceiving the entire river. The direction becomes evident, the noise vanishes, the trade becomes apparent. Here's what most don't grasp. More information doesn't make you better informed. Beyond a certain threshold, additional data simply generates confusion. You begin perceiving patterns that don't exist. You begin reacting to movements that are irrelevant. You overtrade because every tick feels significant. But most ticks aren't communicating anything. They're just random variations within a larger trend. And if you're trading those variations, you're gambling, not trading. Market makers understand that most participants drown in lower time frames exclusively. That's precisely why lower time frames are actually more deceptive. Higher time frames are more reliable. If you determine direction according to the higher time frame and execute your approach only in that direction, your success rate will increase substantially. And this isn't complicated. It's straightforward logic, and it functions. Attempting to identify direction on lower time frames without mastering the higher time frame is leaving your outcome to chance. I recall the exact trade that crystallized this for me. I was monitoring a stock on the 5-minute chart. Textbook breakout pattern. Volume surge. Everything appeared flawless. I entered long. 3 minutes later, it reversed, stopped me out for a $50 loss. I was aggravated. The setup was perfect. So I opened the daily chart, something I rarely did then because I considered daily too sluggish, too unexciting. And there it was, unmistakable. A massive resistance level precisely where I'd entered. The daily chart was broadcasting, "Don't go long here." But I never examined it. I was so fixated on the 5-minute noise that I missed the daily structure. That $50 loss educated me more than any winning trade ever did, because it demonstrated that I wasn't losing because I couldn't read charts. I was losing because I was reading the wrong time frame. Searching for a trade against the daily chart made zero sense. It was no accident that potential long setups were forming for scalp traders who had no awareness of the daily chart at that precise moment. The market maker was effortlessly hunting traders who lacked knowledge of the higher time frame. That's exactly what was happening. Here's the harsh reality. When you trade lower time frames, you're not trading the market. You're trading other traders' panic. You're trading algorithms battling each other. You're trading noise generated by participants who don't know what they're doing. The 5-minute chart reflects emotional decisions. The daily chart reflects structural movement. Emotional decisions are random. Structural movement is predictable. Which one do you think is simpler to profit from? Let me provide a concrete example. There's a trader I know. Intelligent individual, experienced. He was trading breakouts on the 15-minute chart. His win rate was approximately 48%. He was barely break even after commissions. Frustrated, exhausted, prepared to quit. I suggested he try the identical approach on the daily chart. Same setups, same rules, just different time frame. He resisted initially. Daily felt too slow. He thought he'd miss opportunities, but he attempted it. 3 months later, his win rate was 53%. Not a dramatic increase, but his average winner went from $80 to $320. His average loser remained the same. Why? Because daily chart movements have continuation. When a daily chart breaks out, it's not random. Institutional capital is moving, real money making real decisions. These moves persist. They have momentum, they have structure, they have clarity. Institutions don't find it logical to trade on 5-minute charts like retail traders do because of the position sizes they want to execute. This stops being practical, so you can observe their footprints on higher time frames, not on 5-minute charts. There's nothing wrong with trading on lower time frames. The problem is trading on lower time frames without any awareness of the higher time frame. Searching for entry on the 15-minute candle while having no understanding of what the 1-hour or 4-hour candle you're inside looks like. This makes no sense whatsoever. I recommend your approach must include higher time frame confirmation. This will significantly increase your win rate. Let's continue with examples. 15-minute breakouts. Half of them are false. They're caused by algorithms, by day traders chasing, by participants who lack conviction. These moves don't continue. They reverse as soon as the pressure stops. So even when you're correct on the 15-minute chart, you don't profit much. But when you're correct on the daily chart, you make substantial money because the move is genuine. That's the distinction. And this is why every professional trader I know operates on higher time frames. Not because they're more intelligent, not because they have superior strategies, but because they understand that structure only exists on higher time frames. On lower time frames, you're trading noise. On higher time frames, you're trading the actual market. And the actual market is what compensates you. And the higher time frame also makes it possible for you to open larger positions more comfortably. Don't trade on lower time frames if you don't yet know how to read the higher time frame. Find ways to use the higher time frame and lower time frame in a correlated manner. Here's another element most traders overlook. Lower time frames create psychological torment. You're monitoring every tick, every candle. Every small move against you feels catastrophic. Every small move in your favor tempts you to exit early. You're in a constant state of emotional reaction. That reaction destroys your edge. You can't make sound decisions when you're reacting to every fluctuation. Higher time frames eliminate that torment. You execute the trade on the daily chart, you set your stop, you set your target, and then you step away. You check once or twice daily. That's it. No tick-by-tick stress, no constant second-guessing, no emotional turbulence. You've made your decision based on structure. Now you're simply waiting for the structure to materialize. This mental clarity is more valuable than any approach because stress destroys discipline, and discipline is what separates winners from losers. You're far more likely to execute a trade taken on the higher time frame consistently. The probability of your discipline breaking is much lower, but as you descend to lower time frames, these possibilities strengthen. But here's the trap. Lower time frames feel productive. You're busy. You're active. You're executing trades. You're doing something. Higher time frames feel boring. You're waiting. You're observing. You're not trading much, and for most participants, that boredom feels incorrect. It feels like you're missing opportunities, like you're being idle, like you're not really trading. This is the psychological trap that keeps 95% of traders stuck on lower time frames. They can't tolerate the boredom of inaction, so they descend to the 5-minute chart where there's always something occurring, always a setup forming, always a reason to trade, and they lose capital slowly, consistently, because they're trading noise, not setups. The 5-minute chart truly meets all your criteria and appears almost textbook, but at that moment, the 1-hour chart is in such poor condition that it actually reveals very clearly what will happen. Yet you're operating with the 5-minute and can't comprehend how you got stopped out. The answer is simple. The higher time frame dominates the lower time frame, and what the higher time frame indicates happens. That's it. Let me tell you what happened when I finally committed to higher time frames. I went from executing 15 trades weekly to 3. My screen time went from 8 hours daily to 2. My stress went from constant to almost 0. And my account grew more in 6 months than it had in the previous 2 years combined. Not because I discovered a superior approach, but because I stopped battling noise and started trading structure. I stopped reacting to every move and started responding to moves that mattered. The market didn't change. I changed. My perspective changed, and that transformed everything. Moreover, if you truly have a mechanical approach, you can apply it to any time frame. Changing time frames doesn't mean you can't use your strategy. Adapt your approach to a version suitable for the higher time frame and begin trading on the higher time frame immediately. If you want, also trade the lower time frame on the side. Observe how each one concludes, how each one makes you feel, then decide for yourself. Here's the framework I wish someone had given me 2 years earlier. If you're day trading or scalping, you need to understand something. You're not trading the market, you're trading order flow. And order flow on lower time frames is heavily influenced by algorithms, retail panic, and random noise. Unless you're an institutional trader with direct market access and sophisticated tools, you're at a massive disadvantage. You're playing a game you can't win. Now, if you're swing trading or position trading, you're trading structure. You're trading where institutions are positioned, where real capital is moving. And that information is visible on higher time frames, daily, weekly, monthly. These time frames filter out the noise. They show you what actually matters. Not only that, trading on the higher time frame also means more time. You have more time to make decisions. The probability of missing an opportunity is much lower because opportunities don't vanish in seconds. Everything happens more slowly, so you manage better. You can continue thinking rationally. You free yourself from the burden of making decisions within seconds. Thanks to all this, you have more stable psychology. You experience less stress. So everything affects each other positively, and your life is affected positively in the same way. You're walking on a more sustainable path. You're creating less pressure for yourself. All of this strengthens your position and works in your favor in terms of being a profitable trader and maintaining it. But most people want to execute trades more frequently, to watch screens more, to be more involved in this game. But usually, these desires lead not to being a profitable trader, but to being a break-even or losing trader with deteriorated psychology. The problem is choosing paths that make this already difficult discipline more difficult rather than easier. Don't do this. Try and see. Decide for yourself. Here's my rule now. I only trade daily charts and above. I check the weekly for overall context. I check the daily for entry and exit. I never examine anything below the 4-hour, and even the 4-hour is rare. This single decision eliminated probably 70% of my losing trades because those trades were never real setups. They were noise that resembled setups on lower time frames, but when you zoom out, they disappear. They become irrelevant. The setups that remain, the ones visible on the daily chart, those are the real opportunities, and those are the only ones worth taking. Most traders do the opposite. They identify a setup on the daily chart. Then they descend to the 15-minute to find the perfect entry. And that's where they get destroyed, because the 15-minute will show you 10 reasons not to take the trade. 10 little reversals, 10 moments of doubt, and you'll talk yourself out of a solid daily setup because the 15-minute scared you. Don't do this. If the daily chart says go, you go. The lower time frame noise doesn't matter. It's distraction. Always prioritize what the higher time frame shows. Don't let the lower time frame influence you. Here's what I want you to do. Pull up any market you trade. Examine the 5-minute chart for the last week. Count how many setups you observe. Now, examine the daily chart for the same period. Count the setups there. The 5-minute will have dozens. The daily will have maybe 3. Now here's the question. Which 3 daily setups do you think performed better than the average of all those 5-minute setups? I'll tell you. The daily setups performed better not because they're magical, but because they're trading structure instead of noise. They have continuation. They have momentum. They have real capital behind them. This is why higher time frames consistently prevail. Always. No exceptions. If you're struggling to be consistent, if you're exhausted from getting whipsawed, if you feel like the market is hunting your stops, you're probably trading too low of a time frame. The solution isn't a superior approach. It's a superior perspective. Trade the time frame where structure exists, where noise is filtered out, where moves have meaning. I know what you're thinking. But if I trade higher time frames, I'll miss opportunities. I'll be sitting around doing nothing most of the time. Yes, exactly. That's the point. You should be doing nothing most of the time. Trading isn't about being busy. It's about being selective. The best traders I know execute maybe 5 to 10 trades monthly. That's it. They're not constantly active. They're waiting for the high probability setups. The setups visible on higher time frames. The setups that actually matter. And when those setups appear, they commit significantly. They have conviction because the structure supports them. Compare that to the trader executing 50 trades monthly on the 5-minute chart. Always busy, always stressed, always losing a little here, making a little there, never building real equity, just churning their account while brokers profit on commissions. Here's the final truth. The market rewards patience. It punishes activity. Lower time frames encourage activity. They make you feel like you need to trade, like you're missing out if you don't. Higher time frames encourage patience. They make it obvious when there's nothing to do. And when there is something to do, it's clear. Obvious. No question. That's the distinction. That's why higher time frames consistently win. If you want to be consistently profitable, if you want to build real wealth through trading, you need to make this shift. Stop trading noise. Start trading structure. Stop watching every tick. Start watching the daily chart. Stop reacting to every move. Start responding to moves that matter. The market will always be here. Opportunities will always exist. But your capital is finite, your time is finite, your mental energy is finite. Stop wasting those resources on lower time frame noise. Invest them in higher time frame structure. That's where the real money is made. That's where professionals operate. And that's where you need to be if you're serious about this. Higher time frames always win. Not sometimes. Always. Make the shift. Your account will thank you. This is Trader's Mental Edge, where trading starts in the mind.